In this video, I'll discuss the most important indicators that you can use if you want to become profitable, the ones which I use. In fact, one of the biggest misconception when it comes to trading is the belief that more the indicators and better will be the result. But actually that create confusion. If you look at my chart, you have seen many live trading videos with the mentoring participants. I keep always there will be a static support resistance levels, which means a horizontal line that I use couple of pivots, regular CPR and the R1, R2, R3, S1, S2, S3. That the regular pivot, the traditional pivot, and that is for my horizontal support resistance lines. And at the same time, I always keep this Camarilla pivot, but not all the R1, R2, S1, S2, etc. I'll keep only S1, S3, and R3. So traditional regular pivot, I keep all the levels, but for Camarilla pivots, I keep only S3, R3. So that complete my horizontal support resistance. Now, I also need a dynamic support resistance because when you look at the futures is what actually getting traded. Spot is where you get the important levels, important prices, important pivot points. Pivot points means that itself is telling you that's the important turning points. It could be previous day high, it could be previous day low, it could be the average close, right? All these are, what is actually used to, calculate that. You don't want to go beyond, this understanding. You just need to plot that indicators and see that lines or just draw the previous day high, low, close, etc. Now I need dynamic resistance support lines. That's why I use most importantly, especially VWAP, because that already considering volume, and then 20 MA, that's like a universal indicator that everyone is using. So if you're not using, then that is something which is different. And 200 EMA. So 200 EMA will give me a larger picture. 20 MA will give me a shorter, picture. And VWAP is also giving me a volume related understanding. So this is what all I use. And sometimes you see RSI I use for knowing momentum if I'm chasing the momentum. But if you look at my support resistance trades, I don't want RSI. If I'm chasing the momentum, then only I will look at RSI. And if I take counter trades, I look at RSI divergence. So basically, I just need couple of static, resistance supports and couple of dynamic support resistance. Simple. It's as simple as it is when it comes to a professional trading setup. And you don't want, so many indicators like RSI, and along with RSI, then again MACD and stochastic. If all these are giving you the momentum, then why I need all the three? I just need any one of it, and then you keep a Bollinger Band. In fact, in Bollinger Band also 20 MA is coming, and basically we use that only. So again, multiple moving averages, 20, 50, 100, 200, and some people use 21, 42, right, and 84, like that also, and clouds and oscillators and custom indicators. So all these will only create confusion. Make it simple, and simple things work. Otherwise, you'll be confused and you'll continue losing money. So the issue is not that the lack of indicators, it is there. You'll get free also. The issue is having too many indicators, and you don't know how indicator is actually working also. So the reality is that almost every indicator is built from only two pieces of information. Once you know this, then even you stop using the indicators also. But I need 20 MA, I need VWAP basically to know the dynamic trend. I need the CPRs or the static. Forget about me talking about CPR or Camarilla pivot. You can have anything else that helps you, that based on your strategy. I want to know the important levels. So once you have this, right, even that is also derived from what? From price and volume. So volume and price is important. So EMS are basically, you see the closing of last 20 candles. If I'm talking about 20 MA, so that tell me what is the average, and that tell me what is the trend actually in the short term. When you consider VWAP, that is also adding the volume, so that gives me more reliability, right? So everything else apart from price and volume is just a mathematical transformation with these two inputs. Now, once you understand this principle, that can dramatically simplify your trading. You won't have confusion and you won't rely too much on indicator. Right, this is what I want you to understand first. Once you understood this, simple price is enough. These indicators that I've told you, if you have that in your chart setup, that is enough to make wealth. I'm not talking about survival. I'm talking about making wealth, and I've done it. And I'm showing that every day right in front of mentoring participants during the live market mentoring session also. Every day, right? We are seeing that. We are showing that live. So see, why most of the traders fail with indicators. What they believe is, if I find the perfect combination of indicators, I'll stop losing. but there is nothing like that. And because of that itself, you keep trying multiple indicators, and you keep change your settings also, and you keep searching for that secret formula. Now always remember, there is nothing called as perfection when it comes to trading, and there is nothing called as 100%. It is all about probability. So even the indicators are also probability. 20 MA, if it is trading above 20 MA, it is uptrend, but 20 MA can be broken. So immediately I'll have to change my mind also. The moment I see 20 MA is breaking, my now situation is changing. So that is how you'll be taking it, right? So it is not that 100% probable, or I'll just focus on that only. The hidden problem is when you have this 10, 12 indicators which are used simultaneously, they are not giving 10 or 12 different opinion. They are actually giving the same information repeatedly. In that way, you just get confused. And this is just like the same information, the price and volume, repackaged in different forms, and you are not able to interpret that. So that is basically creating that information overload. So because of that itself, you are not able to comprehend what is actually happening, and you are getting confused. Especially if you are a beginner, even an advanced trader also get confused. And see, more the analysis you do, more information is in front of you, that only create paralysis, right? More analysis is paralysis. That's the famous saying. So, see, I have seen my students also, my mentees also, even after joining sessions also, they keep using all these indicators despite seeing every day in the live session. Yes, they take along with me, they follow along with me those indicators. But apart from that, they also keep their own indicators, and they think that some additional money will come from that. It is not going to happen, right? It may happen, but again, it is based on probability. So traders actually not adding indicators because they are working. What I have seen is they add indicators because indicators are actually creating some kind of emotional comfort, or more indicators are giving more entry opportunity. And every new indicator is giving a kind of illusion of a kind of more certainty I'm getting. But is there anything certain? No, it is probability. Even if you add 10 indicators, it is still a probability. Even if you add 10 indicators, still you're not having more control. Whatever control you have, that's the same control. Where is your control? Controlling your loss. And you are thinking that more probability or more confirmation. That's not the case. But actually, what happens is, it's a kind of permission seeking. The more indicators I have, instead of reading the market objectively, you rely on these indicators, and even when you get the best of the trade, you won't enter. You just get stuck because of some other indicators is not allowing you to take a trade. Right? One indicator is telling you that it looks good, take the trade, but the other indicator is not telling you to take a trade. For example, if I am following Camarilla pivot S3 R3, right? Just giving you one example. So I can take a support right here. Can you see this? I can take if that is my indicator. But if I'm adding some extra indicator, some 50 MA, that is coming somewhere here. So I feel like it's going to be a resistance here. So I avoid that. So you will be missing the best opportunity. Similarly, here also, you'll be missing that. Similarly, here also, you'll have a 20 MA somewhere here. So you'll be missing that. So the more, but still, which is the more reliable indicator out of this? This S3 R3. That is why I'm using this R3. Can you look at this reversal which is coming? Can you look at this S3 and the support which is coming? Look at exactly from that level you got the support. Look at exactly that level you got this resistance. So if you have more indicators, then what can happen is, you will get confused. Should I take a call trade from that support? Because just above that we have an EMA, it can get rejected. Similarly, should I take a reversal trade? Because just below that we have a support possibility, so it may get rejected. But this one is having more power, and if you even in case of that bounce, if you manage it with proper risk reward, then that is going to give you the best of the trade. So the truth is, the market is constantly providing you the information. The problem is not the information. The problem is there is too much noise around you. And most of the traders, they have buried the most important information under the layers of these indicators, because of these confusion, because of these uncertainty, because of you seek permission from the indicator. Now, by the time all the indicators give you the permission, you will not be able to take the trade. The price might have gone already. It might have reached that exhaustion point. Right. Even I also do the same. Even now also I do, but that is good for selling. I keep ranking. Right. For example, if I have more than 5 indicators, for each of these indicators, I rank. And then my best indicator is telling you to buy, but compared to that indicator, if the other indicator is not having, buy signal, still I'll go with my best indicator. So, and I can give multiple points also attached with different indicator. That way I can reduce this possibility. But as a beginner or even as someone who's advanced to calculate all these, it is going to take a lot of time and a lot of effort also. So the best is use the best ones which you are comfortable with, which you are confident with, which your real mentor have taught you, something which has been proved already, right? So if you look at it, most of the indicators, how they are building, it is based on historical data. So by the time many indicators, if you see, these are generating the signal. In fact, majority of the big move is already complete. So for example, a bounce is coming. So super trend is negative when the price is below that. Now bounce have started, it broke the super trend, then it turned green. So that is indicating now to buy, but it is already have completed some good move already. So what will happen is, in that case, you will have a late entry, or you will have a late exits, or ultimately you will get frustrated also. So the solution to this is, see, instead of finding the better indicators, there is nothing like that. Remove most of them and return to the foundation of market behavior. Now only three tools are required: price action, volume, moving average, right? So price action, that's the most important, that you should be knowing how to read that. So if you look at this one yesterday, let me show you this. Can you clearly see there is a high, this is a double top, so then there is a possibility of dip. Now this high, lower high, now there is a lower high, so there is a trend line which is coming here, these three lines, and further there is a lower high. So now this looks like the trend is going negative. Now you can also see here, this was the low, high, right? So this is high, lower high, lower high, lower high. So this was the low, now made a lower low, and further a lower low. So lower low, lower high formation. This is how you can read the price also. So first and most importantly, you should be in a position to read the price. Then, as I told you, you need to understand the volume. If I need to trade a breakout or breakdown, and VWAP is something which you can use so that you'll get volume and average price and moving averages. Typical ones which you can use is 20 EMA and 200 EMA. Maybe to fix the stop loss while chasing a trend, you can keep a 9 EMA also. So the price action, right? When any market analysis, if you take, what is a foundation? What is a fundamental? It is a price action. What every indicator is trying to do, every indicator is basically attempting to describe the price only. So what 20 EMA is trying to do, it is describing the price of last 20 candles, right? And what 200 EMA is doing, it is describing the price of last 200 candle. What is VWAP is doing, it is describing the price of the it is describing the price and volume. So you get an idea about both, right? That is why I rate VWAP much higher. So price itself is always more important than any of the indicator. Now, what is price, right? Price means there will be a point which I call as equilibrium point, and that's the market language. So that is where the demand and supply match. That is the equilibrium point. Buyers agree to buy and sellers agree to sell. So every factor affecting market, that is just compressed into one number. That is that equilibrium point, equilibrium price, equilibrium quantity, right? And that is what you mean by the price. And what are the what price represent? It focus on many other things, right? The fear in the market. Because of fear, you may exit. So you may become a supplier. Greed in the market. Because of greed, you may try to create demand. So you will create demand, right? And the news that can affect the price, institutional activity, selling or buying, retail activity, expectations of future. So tomorrow, when you see Gift Nifty is crashing like this, I'm expecting the market is going to crash. So now that will be reflected in the price, that fear, right? Now, the objective is not predicting the future. The objective is what? Understanding what market is doing now, because we are intraday trader and we are trading on that only, and we make money accordingly, by understanding what the market is doing right now. So right now, what I need to do is what I'm looking for. I'm not looking to predict, right? What can happen? I'm not looking at it. I'll enter based on my scenarios, situations, by understanding the price. I keep the stop loss. That's the one thing which is in my control. I keep trailing it. I keep partial booking also, right? So the price used to create the structure, as I told you now, lower high and lower lows. So it's clearly a downtrend. It is now coming. So it could be a upper structure, normally higher highs and higher lows, which means buyers are in control. Or like the one which I have shown you, lower highs and lower lows, where the sellers are in control. Or in a sideways market, there is, in that case, there is no such sequence like lower high or lower low or higher low. That will be a choppy movement like what you got yesterday, right? That's a kind of sideways market. So in sideways market, what is the best action? You just wait, or you just scalp between the extremes if you have some pivots which are available. The pivotal point is the most important. Pivotal point, what I mean by that is it is not just the CPR or R1, R2, R3. What I mean by really pivot point is the turning points. This happened when it, see you here, let me show you. See, look at this. For me, there is no lines here. I have the CPR, I have the R1, R2, etc. there, right? Or I don't have any Camarilla pivot or anything. But this is the pivotal point for me. Why? Because price got rejected here. Here also, it got rejected last day. Next day when it came, it got rejected. Then again, it got rejected again. Then again, it came, it got rejected. Now again, look at this, it is getting rejected. Again, look at this candle where it is getting rejected. It is almost there. So this level, this is my pivotal point. This is the turning point. This is where suppliers are there. That's what I mean by pivotal point. It's not necessary that you need to have a R1 or R2 or R3 over there, right? So pivotal point means a level where the market change its character. It basically represent what? Either an important support or an important resistance. Or in another language, if I need to put it, it could be a demand zone or a supply zone where maximum selling can happen or buying can happen. Right now, what do you mean by bullish pivotal points? What do you mean by bearish pivotal points? For a bullish pivotal point means let's say some resistance is there, right? The one which I've shown you, it is given a proper breakout with volume. Now that is turning. Previously, it was repeatedly failing at that level. Resistance, resistance, resistance. Now it is breaking with volume. Now that is becoming a bullish pivotal point. Also, support can be a bullish pivotal point. The reverse is for bearish pivotal point. A support level multiple times attempted to break that. It did not break, it bounced. So that now is going to break with volume. That is going to be a bearish pivotal point now. Or at the important resistance level, the price is turning. That is also a bearish pivotal point. It's a breakdown or resistance zones is what I'm talking about, right? So basically what I want to tell you is do not trade because just that just do not trade because that level exists, right? So we have to see that the market is also proving that the level is broken with volume, right? And that is why confirmation is very important. So many traders actually buy before breakout or before breakdown by anticipating. But what the professionals will do, what we do, what I do is we wait for confirmation for that breakout with volume. Even just the breakout is not enough. After the breakout, we wait for a retracement also, or a marginal quantity we enter upon breakout, and then we wait for retracement for the significant quantity. So that is the difference between a normal trader who comes for time pass and a professional trader. Normal trader try to predict this is what going to happen now. We should never do that. We should wait for the evidence. We should wait for that confirmation that the breakout or breakdown is with volume. Okay, now see why I give importance to volume, because price is enough. Now you tell me, or you think that when the price is giving confirmation, then why volume? Price will tell you what happened. Yes, there is a breakout of important level, but volume will tell you whether you have to believe that breakout or breakdown or the price. So then let me put it in this way: price tell you what happened, volume tells you whether to believe what happened or that price move. So what is basically volume representing? That the number of shares which has been, or the contracts, if it is futures and options, which has been bought and sold. But more, it's not just that. More importantly, volume actually represent. This is what I take from volume that shows the commitment at that level of those who have given the breakout, or the conviction of those big players who have given the breakout or breakdown, or the participation. So when participants are there, I can go with them. When conviction is there, I can go with them. When commitment is there at that level to protect, then I can go with it, right? And that is why volume is very important. See, price can move even with little effort also. Even without significant volume also, price can move. But that doesn't mean real money is participating. But when you get the breakout or breakdown with volume, then you know, and that is the most important combination in trading, then you know the real money is participating. So when I talk about the strong breakout, what is the condition? Major level, as I have shown, that breaks at the same time, volume also comes. Then I can believe it. But if you look at yesterday, you see this is the major level, 1, 2, 3, 4. Now this is becoming a major level breakout. Is there a volume? No. Should I believe it? No. Simple as it is. So that, you know, price will tell you what happened. Volume was telling you whether to believe it or not. So that is why if you look at my trade yesterday, I've taken a reversal trade, especially after the governor's speech, and we have made a bigger trade also over there, right? Because if this condition is there, major level is breaking with volume, then you understand that the institutions and the large players are participating. That is where I find the commitment and the conviction and the participation which I'm looking for. In that case, the probability of that trade becoming successful will be significantly higher. Now, what is a weak breakout? You get the breakout just like the one which I've shown you, but no volume. Volume remained low. So that shows no conviction. That shows no commitment. That shows no participation. Should I go with it? No. So there is a high chance of failure. When I know this business is going to be a failure, should I do that business? No. Right? So the important volume rule is, the first rule, breakout should occur with increased volume. No volume means no trust. No volume means no commitment, no conviction, no participation. And rule two, this volume should happen with a proper trend. That will be another, if for example, in a healthy uptrend, volume is also increasing during the rallies, right? And when the pullback happens, the volume decrease also. That shows buyers still remain dominant. In the rallies, volume is there, but sometimes you get the pullback, and I call it as healthy pullback. So that time volume is less. So in the rallies, you get the volume. In the breakouts, when you make higher highs, you get the volume. But when you make the this lower, higher lows, then the volume will come down. That is pullback in that case. That pullback is healthier, and that's a retracement where you can enter. Rule three, that's a danger side. If the pullback occur with higher volume than the rallies, in an uptrend, you got the rally, volume is there, but the pullback is with higher volume, then you need to be very careful. You should not enter on the retracement. Otherwise, I wait for 20 MA. I see if the pullback is with less volume, then I'll enter. If the pullback is with more volume, I don't chase the retracement because that's a falling knife I don't want to capture. Right? And what is this volume climax? That's one of the powerful concepts. See, after a long rally, volume suddenly explodes, and automatically you will see price accelerate dramatically, especially if you are trading options. Like, right? So some spikes maybe from 100 to 200, and this 200, the moment reach 300, then 300 to 500, 600 will be like explosion. And what majority of the thinkers think is, now the trend is becoming stronger. Actually, here is where the trend is nearing exhaustion. Why? Because here is where the late participants finally enter because of FOMO. And once everyone has bought, who's left to buy? Very few. So market become vulnerable at this point of time. So always remember price and volume together. Price gives the direction, volume gives the validation, confirmation. Together, they create a high quality trading decision. Now, what is the third tool? Moving average. VWAP also, these two. Right, so the moving average, in fact, is the most underestimated or misunderstood tool in trading. Most traders actually using it incorrectly. What is a moving average? Moving average is simply calculating the average price over a period. It could be 20 period, or it could be 200 period, it could be 100 period, nothing more, nothing magical. It's just average price. What is the purpose of moving average? I try to enter close to moving average. It give you entry timing, it give you exit timing, kind of small prediction also, right? But it should not be taken it in that way. Now, let me show you. Okay, here I've not added. So some people consider, just before also I've told you, right? You will enter near 20 MA. Yes, near 20 MA means it's not an entry signal. This is a range. This is an area where, like me, many others can enter. So you get a context here. So when I say, let's say Nifty 25,400 is where 23,400 is where 20 MA. So it doesn't mean 23,400 is your exact buy signal. It can be 23, 450 or 350, right? That range, it's a box. It gives you the direction. Above the moving average, it gives you the direction on the uptrend. Below, it is downtrend. It gives you the trend context. It also tell you market bias. And you try to enter near to the EMA so that you get best average price. What is moving average? It is average. So we cannot be entering at a higher price. We cannot capture from the bottom. The best scenario is what the best average price we can get, we get there. So it tell you the direction, it tell you the current context of the trend and market bias. Not definitely never treat as entry signal or entry timing, or it help you to predict. Not in that way. Exit, some of you, right? I used to keep 9 EMA. If they break 9 EMA, there is a possibility that it can come to 20 EMA. So I exit from a trend trade, and then I look for retracement to 20 EMA also, right? And there is a river analogy, very famous. You just need to think market as a river. Moving average answer basically which direction is the river flowing. That's how you need to take it, right? So the common mistake that I've seen is many traders buy because price closed above moving average, or they sell because price closed below moving average. So what actually happens is that create whipsaws and that create losses, unnecessary drawdowns and confusion. That's not the right way to trade it. Not immediately. Understand the context, and based on that context, you have to trade accordingly. So the correct use of moving average as a filter, it's not as a trigger. In case of bullish environment, the condition is that price should be above moving average, 20 moving average, short term, right? Price should be above 200 moving average if the long term trend. Price should be above VWAP, and moving average should be sloppy, upside sloppy, bullish environment. So you look for a long trades. Bearish environment, price should be below 20 MA, price should be below VWAP, price should be below 200 MA. It should be downward sloping. Then you look for a short trades. What is a flat moving average? If moving average is flat, then the price is consolidating, there is no trend, and you just stay out. Why this is important? Because you may see a perfect breakout and a strong volume, but price is below moving average, right? Then the dominant trend is different. You see the level is breaking, but the dominant trend, the EMA is here and the price is here. You got a breakout. That is one of our indicator that we are talking about, major level. The price is breaking out. Volume is also coming. But this is a major resistance. It can be 200 EMA, it can be 20 EMA, it can be VWAP. So dominant trend is what? Negative. But within negative trend, you are getting a breakout. Do you believe it? You should not believe it. So in a trending market, then you should be getting it. That is when it is good. So these three, that give you the proper confirmation, right? So see, it basically help the traders, or it actually prevent you from trading against the larger trend. Simply, if you make this rule, if the price is above VWAP or moving average, I take long trades. If price is below VWAP and moving average, I take short trades. In that case, price is below VWAP or moving average, you're getting a breakout and volume and everything. You don't have confusion because dominant trend is downside. This breakout, I'm not going to believe it. Similarly, you are seeing prices above moving average, but you're getting a big breakdown with volume from the higher level. But price is above moving average. So dominant trend is positive. You are getting a breakdown. I don't want to chase it. So all the three should align. So you are not trading against the larger trend. That is, how moving average actually act as a guardrail. If you combine all these three tools, then it is going to be easy. Understand the price, understand the volume, understand the moving average. So for direction, you use moving average. Which direction the river is flowing? If the price is above moving average, bullish, below, bearish. Then the location, that is the price action. Important pivot points. Are you getting a breakout or breakdowns? The pivot point means the level that can change the market character. What is the confirmation? Volume. Now these three should align. I hope you got it. So whether the breakout is supported by conviction or by commitment or by participation, that is very important for me to chase that. So trade only when these three align. The direction that you understand from VWAP and moving averages, the location that you get from the price, the confirmation, commitment, participation that you get from the volume. So moving average plus price plus volume give you that edge. This is what I want to discuss basically. See, In fact, if you follow this framework, it work everywhere. It work in stocks, indices, forex, commodities, crypto, everywhere. It work in 1 minute chart, daily chart, 5 minute chart, 15 minute, weekly chart, monthly also. Because what is the logic behind it? Logic behind this is human behavior, and human behavior never change. But always remember, these indicators, these tools are not the edge. It is the one who's using the tool. You are the edge. That's something which you need to keep in mind. The way you use it and I use it will be different. And that's why you might be losing and I might be winning. Okay, so all these we will be discussing in our live market. I'll show you how we trade everything in the live market. If you're interested, you can join and you can see how we trade in the live market. And that's how I teach in the live market mentoring session. Now, why still traders are failing? Despite knowing all this, despite explaining all this, you have listened to this much and tomorrow onwards you can practice. The issue is that you enter too early. You don't have patience. How many times you have seen in my videos, I'm just waiting for the trade. Just wait for the trade. I don't do anything. I just keep waiting for the trade. Sometimes my trade will come very late also. Or you might be taking too much of risk by expecting this can be a bumper trade. Or you ignore the stop loss. Or you hold your losses for quite some time. Or you act emotionally. And that is the reason why you're actually losing. You're not. That is the issue with a normal trader. A professional trader won't enter early. That patience will be there. You'll see from my sessions also. I won't risk too much, despite having that heavy capital, in fact, unlimited capital. If I don't have capital, I have thousands of people who are willing to give me capital also. At least I am fortunate to have that. So unlimited capital is there. Still, you look at the risk that of course, in option selling, we take huge position, and that is a 10 crore account. That is different. But option selling, we have that edge also, so we can blindly go with it. Or you ignore stops. Don't do this. So the real source of success is actually patience, commitment, discipline, and most importantly, risk management. So what we discussed is, before every trade you take, you ask, is the direction is correct? Is it in an uptrend and I'm taking a downside trade or not? If the confirmation is there, mean reversal trade, double tops and all, then you can try, but a small quantity. That's a different case, okay? My location is correct or not, whether the price is at the pivotal point and giving a breakout, or there is volume, the confirmation, commitment, the participation is there or not. If all the three align, take the trade. If not, just wait. The market does not require hundreds or tens of indicators or 12, 15 confirmation or any complex system. The market can be read, you can understand effectively just by using price action. You will understand what happened. With volume, then that will tell you whether to believe what happened. And moving average, that will tell you what is a dominant trend. Even if price is giving a breakout and volume is also there, that means what happened is you understood breakout and you can believe also, but if it is against the dominant trend, still you won't trade it. Right? So because of all, if you can use all the three together, that give you clarity and your system will be simple. You get a proper structure and you can be disciplined, and there is no need that you can break the rules if you can follow this. So the goal is not to trade more. The goal is to trade better. Right? And if you see, the traders who succeed are not the ones with the most indicators or keep on taking trades, entire day. They are the ones who actually understand the market clearly and act only when the evidence is clear. Yesterday, if you see, after RBI governor speech, we have spotted the top and we have taken a put trade. That shows how we understand market clearly. How many of you can take it and how many of you have taken it? We have done it, posted the live videos. Right. So see you guys in the live market mentoring session. Thank you.